I'm Carmen Balber, Executive Director of Consumer Watchdog. We had two massive fire years in California, 2017 and 18. Insurers had huge losses. What they don't like to talk about is the fact that they recouped a lot of those losses from the utilities who were responsible for a number of those large fires. PG&E alone repaid $11 billion to the insurance industry for their role in the 2017-18 fires. And if you can move on to the next slide, insurers in California, contrary to the story they tell the public, have done as well as or better in California than they do nationally. And these numbers are from the National Association of Insurance Commissioners. There are various measures of insurers' income and profits. The bottom one is the most comprehensive because it includes not only what they're spending and taking in, but their investment income. And California's return on net worth was 2.5 points higher over this 20-year period than the national average. So California is doing better than the country. And if you can move to the next slide, this plays out in the most recent years we have data for. Just looking at the years right after those fires, the gap is much larger between how much better California is doing than the nation. And these are tiny, but you can maybe flip to the next slide just to focus in on that return on net worth number. If you see 2019, 20, and 21, which are the most recent years that have been released, California's return on net worth in the homeowners insurance line was 19.4% compared to 1.3% nationally. So the narrative that the insurance industry is going broke in California because of the specifics of our state and our regulatory system, which is really their target, is some misinformation. In fact, we looked at State Farm's numbers for the last 3 years, so 21 through 23, and compared the returns of the California Home Insurance Company and the one that covers everyone else across the country. And the loss ratio, which is the best number we have access to right now, in California was 62.5%. Nationally, it was 71%. So what is going on here? State Farm is doing better in California than they are nationally, yet California is the place that they're targeting for pulling out. And that is because the insurance industry's biggest target here is rate regulation. The voter-approved ballot measure, Proposition 103, that was passed in 1988. In 1986, the Little Hoover Commission, some of you may know, did a study on an insurance access and affordability crisis, and at the time called out the serious failures in insurance oversight in the state of California. And a few years after that, voters passed Proposition 103 to address a lot of those failures. And Consumer Watchdog is one of the primary organizations, although we are not the only one, that participates in Prop 103's public review process, which is requires companies to open up their books, to justify their rates, to get approval from the insurance commissioner before those rate increases go into effect. It requires full transparency of everything that goes into an insurance price. And it allows for this public participation process. So members of the public can also say, open up the books, hire an actuary, an attorney to look at the numbers and say, this rate increase looks excessive. I would also like to challenge it. Someone is asking about rate increases. I just want to make clear that home insurers are in fact getting rate increases in California. They've gotten 92% of the premium increases over the last 3 years that they've asked for. Most of those were at the full amount they asked for. Some of them were reduced because the Department of Insurance or interveners like us felt that they didn't need as much of an increase as they wanted. The average increase was 13%, but they went up as high as 65%. And so insurance companies are getting to factor in these legitimate cost increases into their rates. It's all of these solutions that the industry is pushing in California, and that the commissioner has largely announced he's going to do in his sustainable insurance strategy, have failed to fix the market in Florida. Insurers are leaving there. Their rates are 2.5, 3 times as high as California's, and 5 times as many people are in their FAIR plan. So all of the solutions the industry is pushing is not stabilizing the market, which is why we think we need the solution that is a mandate to cover the people who are not risky. I just want to also clarify something about the commissioner's plan, which is out there and he's never directly addressed. In return for all of these reforms, deregulation, we would call it, that the insurance industry wants. The consumer benefit in the insurance commissioner's deal was a promise by the insurance companies that they would go back into the riskier wildfire areas, that they would sell 85% of their market share in the rest of the state in the risky areas again. But we have never seen an insurance CEO come forward and testify that they have in fact made that commitment. And we did a Public Records Act request to the Department of Insurance and obtained the text of the legislation that he had negotiated with the insurance industry at the end of the legislative session last year. All of the points from his sustainable insurance strategy were in that bill, including this 85% commitment. And the language of the bill says that insurance companies could meet their commitment not by selling a standard comprehensive home insurance policy, but by selling a bare bones fair plan equivalent, which would mean consumers who, under the public presentation of this deal might think that they're getting access to home insurance again, would in fact be stuck in exactly the same position they're in today, which is they have access to the fair plan. Now they just be buying a fair plan policy from State Farm. And so if that is the case, then consumers will have literally gotten nothing from what the Department of Insurance is proposing. And we will be in a situation again where we're trying to find a solution to getting people access to coverage. So I just want to, and we've asked the insurance committees of both houses of the legislature to grill the department on this, and they have yet to ask the commissioner that question. So if you get him here, it would be amazing if you could ask him if that's really what this 85% commitment means. And the last slide is just our solutions, and I think we talked about most of them. But one of the decision points needs to be whether or not Californians have done what they can to protect their homes from burning down in a fire. We need a mandate that insurance companies do in fact have to underwrite those people who do the right thing and harden their homes, or are in a place where they are not facing those catastrophic risks. Yes, there are uninsurable homes, but we do need the legislature to step in and say, the insurance industry can't decide who can afford to or where Californians can live. That needs to be a public policy decision. California, when the voters passed Prop 103, they put in place a mandate that auto insurance companies have to sell to every good driver. So we have a mandate that good drivers get insurance, not folks with bad records or drunk driving, similar to people who build a home on the top of a mountain and won't protect it. Okay, I'm not saying you've got to insure that very bad risk, but people who do the right thing and are insurable should have access to coverage. And the stick to make sure they follow through is insurance companies should lose the privilege of selling here, not just home, but auto insurance, if they refuse to sell to the people who are least risky. I think maybe the only one we didn't touch on is the need to be smarter about where we're building. So if we do impose a mandate that you have to cover people who are safe, that doesn't encourage more building in risky areas that no matter what you do, it's not going to be a safe location. So I think maybe the last piece of that is just really needing to do serious investment in mitigation, because we can't just insure our way out of this. We need to reduce the risk in California, and the state is very focused on reducing the risk of climate change. But in the short term, we need to reduce the individual risk, and that is investments in mitigation, not just by the state, but we think the insurance industry has to have a hand in that. And one thing Commissioner Jones pointed out was that the insurance industry is contributing to the fossil fuel crisis by both investing in and underwriting fossil fuel companies. There's a proposal in Connecticut that is being talked about right now that would tax companies that invest in or underwrite fossil fuel companies and use that money to help subsidize mitigation. I think that's a great idea.